You know, Peter, you're not necessarily not in the recession camp. I think you expect it, just not for a long time. Is that right?
Well, Sarah, thanks for having me. But yes, we about a month and a half ago, we came out with a call there would be a recession beginning in the second half of next year. You know, it's pretty rare that you have this kind of advance warning for a recession. Anytime the Fed's going to have to step on the brakes substantially, it's a very high probability down the road.
David, why do you see it happening sooner?
Well, look, I think that you can build a case that the recession has already started. You know, when you consider that 80% of the economy, otherwise known as real personal disposable income, has already contracted 4 quarters in a row, was minus 2% in annual rate in the first quarter, minus 6% in the fourth quarter of last year. So as sure as night follows day, consumer spending is going to follow the trend in real personal disposable income. And the only times in the past when you've had 4 quarters in a row of negative prints on real PDI, the economy's been in recession. And the only thing I'll say is, you know, with all deference to Peter and to Ben Bernanke, and I know Ben Bernanke also told us that the problems in subprime are going to remain contained and that home prices wouldn't go down nationwide.
That's fair.
The stock market peaked at the beginning of the year, and the lead time between the peak in the market cycle and the peak in the economic cycle is not 18 months or 2 years. It's usually 3 to 6 months. So actually the markets are handing it to you on a silver platter.
Peter, I mean, there is increasing concern if you look at the market and what's been working the defensive sectors and how the equity sell-off has been relentless now, almost 20% lower. How do you respond to that? Is the market overpricing a recession risk, or does it have it right?
Sarah, no question. There's the risks have increased substantially here. But, you know, I'll grant David a good sector recession, something we've been expecting as the consumer rotates from goods, way overspending on goods to getting back to spending on services. That's been in the works, and that's going to continue. Stock market's down because it's pretty heavily concentrated in the goods sector. Now, I think going forward, it is going to be a consumer that is going to be benefiting from real incomes, which have been falling lately as with high inflation overtaking wage inflation. But we do see some easing of inflation ahead with wages picking up further. So by later this year, we expect to see real incomes actually rising again. And it's going to be the Fed getting into action, getting rates up substantially further that finally pushes us into recession by the end of next year. But I will grant you one significant risk there. As I'd said earlier, rarely have we had this kind of advance warning, and it is altogether possible that the market could telescope some of this forward.
So it all comes down to the consumer, David, and Walmart earnings are coming out tomorrow, and we're going to hear for all this week from Home Depot and Lowe's and Target, and they'll be really interesting. But so far, we really have yet to hear any warnings from any consumer companies, including the credit card companies, that the consumer is weakening. And I know you think that it's going to happen, but really all we keep hearing is the consumer's in great shape and consumer balance sheets are strong and they have a lot of savings and all that. So why are you more pessimistic about consumer spending?
Oh, look, if you're bullish on the consumer, you want them to take that strong balance sheet and weaken it by reducing their savings and increasing their spending. And that's just an assumption that a lot of people are making. The strong balance sheet is equivalent to the fact that people are cautious and are going to be maintaining high precautionary savings balances. You're talking about the consumer, and you're talking about what companies are saying. Sarah, companies report in nominal dollars. The recession is not a nominal dollar concept. It's about real dollars. Nominal GDP never went negative in the 1970s. We had 3 recessions. Why? Because real economic activity, including real consumer spending, deteriorated. Real consumer spending, by the way, has completely flattened from October to March. Over the past 6 months, there's been no growth. When you include services and goods together, the consumer has flattened in real terms. So, you know, maybe when next time you get a CEO on, ask them, so tell us what your volumes have been doing, because we know that they've been jacking up their prices. So, of course, things look really great in nominal terms. I think the next leg of this is going to be the
volumes rising with price hikes. I've seen
Pardon
that in
me?
the consumer staples. I've seen volumes rising with price hikes. Yes, they're getting a benefit from pricing.
No, Sarah,
but...
Sarah, volumes. When you look at the monthly data flow, consumer spending volumes have been flat since October.
So overall, you're saying that there's no movement. Peter, last word: is the consumer in good shape or not?
Hey, this labor market is still going gangbusters. We have, 2 job openings for every unemployed worker. Jobs look good. I think earnings are coming back. Wages are coming back later this year. I still think the consumer can hold up. No question the risks are rising, but this is an issue for the second half of 2023 after the Fed gets rates up quite a bit more.
Shepard Smith here. Thanks for watching CNBC on YouTube.